So you should not actually be wary of that company is going to die. Company will not die because of the bad results. Maybe because the market was not bad for a particular year. That's the reason stock has gone down. And again, this will outperform because when the market revives, it definitely has to bounce back.
Joining with me on today's episode is the founder of Unlisted Assets, Mr. Manish Khanna. Hi, Manish. Thank you so much for joining us. How are you?
Thanks, Lekha. I'm doing well. How about you?
Great. Thank you so much for asking. So, Manish, give us an overview of your company, Unlisted Assets. What does it do, and what role does it play in the Indian market for trading of unlisted shares and ESOPs?
Yeah, sure. So let me just give you some background actually where we started. So although we didn't have much of a background actually when we started unlisted market, when we looked at the market actually only, we looked at how the ecosystem is working, and then we realized that there are a lot of gaps actually which we can fill through technology, and rather it's only and only the technology which can actually fill the gaps. There is no manual intervention which can actually work around here. Although there might be some manual intervention which can work for a time gap, but eventually the problem has to be solved on a scale as well as on a mass basis. So you need technology. So we worked almost like on a 2 years. So we basically looked at the problems first. So we looked at the problem even from institution as well as from retail angle, and we realized there are massive levels of problems actually when it comes to education, empowerment to users or investors, and the market is scattered all around. So it is basically, I wouldn't say misguided, but it is guided by or influenced by some of the people actually who might be wealth manager, who could be actually, the investment bankers, or who could be actually advisors to, retail investors or HNIs, or at times to the institutions. So they influence actually some way or the other, and basis their advice, somebody buys and somebody sells. So nobody knows what price point to enter, what price point to exit. So I took a exit, I made a loss, maybe I'm just holding on to. And there was a need to attach liquidity. So eventually what we try to build actually is a liquidity solutions around, not only just one asset class. We realize there is definitely a need down the line to create a liquidity protocol for all the illiquid asset class. It could be bonds, it could be shares, it could be AF, it could be, XYZ things where investor need a exit. So today, if you look at the entire regulatory framework also, the government is also trying to push towards. Like, I'll just give you a very small example, although not related to us, but obviously the intention of the government actually comes out when you say your money, my money, or maybe somebody else's money is stuck in, we opened a lot of bank account, and a lot of people died in COVID. So there was a health insurance, or there was something actually policy insurance they have taken, but there is no claimant because most of the people who are matured, like maybe their father, the two adults in the family died, kids cannot claim. So there is an unclaimed money actually lying in with banks, with insurance company, with XYZ. So there is definitely a problem at their end. The same thing we also realize there is a problem at a retail end, where basically he might be having some stocks or maybe some ESOPs actually in their pocket, and this may not be actually having the liquidity tomorrow, and cannot be actually solved through a problem, through a solution which is not tech-enabled. So we basically realize there is a need to create a safe, secure, transparent ecosystem of liquidity where actually both the buyer and seller actually can, transact between them. We realize as of today, there is no place where both buyer and seller can meet and then eventually solve their problems. That means somebody is willing to buy, somebody is willing to sell, but there is no price discovery happening around. So the way that things happen in the listed market or listed capital market, the same thing ideally should happen, because we have seen the global markets, and we realize there is a alternate trading systems there in the global market, in Singapore as well as in US. The same thing will get replicated over a period of time. The only thing is that because our regulatory is a bit slow, so we actually catch up eyes with the global, and then eventually we try and scale. So what happens actually is, at the end of the day, we try and follow someone which is US. So I'm just actually taking the clues because there are already unicorns actually coming from US and have been doing both the retail as well as institutional level deals. So say for example, there are Forge Global of the world, there are Katas, then there are Equityzen, then there are multiple others who have been built like a platform for providing liquidity to retailers as well as to institutions. The same basically kind of thought process we also framed in. and we did, more than 2 years it took us to actually work on the product and then come out with the market to actually solve multiple level of issues. Say for example, if I just talk about say retail, it will be providing the safety through bank escrow mechanism, then security of the funds also comes through that. Then there is obviously sense of kind of transparency. So we brought in actually kind of a price discovery mechanism that okay, there is a buy now product where you can actually instantly buy. Then there is a sell now where you can instantly look at selling your product. So at your price only you are trying to do a price discovery. So maybe, and then there is a negotiation system which we build. So in case you don't want to sell on an instant basis, you can immediately get into a negotiation basically with the buyer and seller and can conclude the deal. So there is definitely a law also which we need to follow. So we eventually at the back end have made the system in a stepper way, but so smooth and actually the process side that you have to just do click and then you are in. I mean to say your buying is done or your selling is done. So in a way basically we realize that there is a money control kind of a system which we need to actually create to empower a lot of users, because today if you want to see something on the listed side, you go to the money control, you go to say XYZ like screener or maybe some capital market tools. So we actually are trying to provide a comprehensive tools so that you can actually be empowered as a user to evaluate actually on your own. So I don't want to be your buyer advisor or a seller advisor, because what happens is then I become an influencer. I really don't want to become an influencer on your side or their side to actually influence the deal. It should be a price discovery driven by, if you are a seller, there has to be 10 buyers, or maybe if you are a buyer, then there might be 10 sellers. So price discovery helps you to get you the best price out of the entire deal. Now that's what basically we realized. Then there is obviously trust issues. So through SEBI registered trustee, we tried and solve the entire equation of trust. Because I may be banker actually, I may be an intermediary, I may be an advisor to someone, but who's going to trust? Buyers are both unknown to each other. Even an advisor don't know many times both the parties. So buyer and seller definitely has to create an ecosystem of trust. So we realize there is a need to have some intermediary who is trusted by both buyer and the seller. So we brought in SEBI registered trustee, which basically is a well-known player, or you can say is a kind of a trustee who's definitely take care of the trust part actually between the transaction go or no go part. So if if there are no condition getting met, obviously deal doesn't go through, and then if the conditions which are stipulated in the agreement, it definitely get met. So eventually trustee take care of this part, we even don't take care of this part. Similarly, the funds basically, although you are giving the funds to one of the your wallet which is managed by us, we don't have authority to actually touch the money actually. So either the money actually will be refunded back to you in case the transaction get cancelled, or you will have a transaction successful and the money will get credited to the seller's account. So in a way, once trustee approves only, then the money transfers approval get into place. We don't approve or disapprove any kind of a fund movement. So we have no authority out there. We don't approve any transaction per se otherwise. We just do a facilitation job. So in a way, basically, we realize there is a need to create a kind of infrastructure or a tech infrastructure where somebody can land into, can actually get the information what they need, be it on the last round valuation, be it on the company, promoters, financials, whatever, to the best extent we can actually provide more like a free public information and compile at a single integrated location. Realize there is a need to provide some kind of education also to them. So we started writing blogs, started writing articles, started doing PR, started doing a lot of educations. People should, realize, see, a lot of people actually are sitting with the, ESOPs. So they don't have actually choice when it comes to liquidity. So they go to, maybe any advisor, or they may go to certain people actually who don't really understand the space. So first we are empowering the user that, okay, this is the process. How do you liquidate your ESOPs? So all that stuff basically we have tried to look at from those angles. Similarly, on the institution side, what we are trying to do, we realize there is a 1919 infrastructure basically which people are using. They didn't have actually the right access of the tech infrastructure. They might be open to adopt the tech, and slowly and steadily they will have to, because the global market is moving toward tech adoption. So in a way, if the market has to be a free market and there has to be price discovery, it can only happen through technology. So price discovery is like, say for example, today you are trying to sell some large block of an unlisted company. How do you sell it? So you invite bid. Maybe your bids actually go to only maybe 10-20 people, and you get a successful bid from only 2 guys. So LOIs are, only 2. So what you have is 2 LOIs. Now the choice is yours whether to accept or not to accept. Now you are gone actually the moment actually you don't have any other third. So what you are left with only 2 options means it is not a fair, it's not a price discovery. Auction was, a price discovery, but how many people get to know there is an auction actually of NSE shares and everybody, participate in that. So what we are trying to showcase is we are trying to notify each of the market participants that there is something actually happening across. Now you need to participate if you are interested. And there is a bid actually which you will place. So the way IPO, happens. So there is a, book building process. So there is a price discovery which happens. The same way ideally it should happen actually in the unlisted market also. If there is a large block deal, although there is no listing happening across, but there is a deal actually which is voluminous. So there has to be a good, or I would say good number of participants which has to be there on the platter so that people can choose, they can choose that which one is better, which one is not better. So what we have done is basically we have created an anonymous deal matching. So you never get to know who's the buyer, who's the seller. So even if you are a distressed seller in the market, you never get to know whether I am in a distress, situation or not. So in a way, basically, if someone actually wants to try and sell, his identity never get disclosed. So suppose if you get to know that this guy is a distressed guy, you will never give him the 100 rupees which he deserves. You will always say 50 rupees take or leave. So that's what is the mindset of the people actually, which we realize that need to get changed, and there has to be price discovery around that. That's the reason basically we brought in anonymous deal matching window along with the transaction tools, so that transaction tools actually can be a kind of acquisition strategy for us to evaluate and then eventually bring someone on the table as an institution. So now when I talk about institution, it could be anybody other than the retail guy. So it could be family office, VCP, it could be any say for example any foreign institution or Indian institution, all could be there as a participant. So that's basically is the synopsis of our product basically. And we launched actually last year. We already have added a good number of users over there in the retail, and institution also are more than 50 we have already added to our platform on the institution side.
Okay, so actually a good point that you mentioned that in the US you already see that saw that happening. You saw a good opportunity, and that's where you started as well. And we'll go on that on the later part of the interview as well. But before that, can you tell us a few pros and cons of unlisted assets, investing in unlisted assets and shares?
Yeah, correct. So first of all, that unlisted asset basket is very, very big. Or even if you talk about unlisted share market, it's very big. So there are, we'll say, for example, more than 12 lakh companies in India registered as, not startup, but otherwise, all companies, all private limited companies. Out of that, there is a subset of 70-80,000 companies. So out of that subset, there is a, listed companies. So I'm talking about the entire universe of companies basically which are registered with MCA. So if you bifurcate them, so this 70-80,000 is publicly limited. That means their share can be freely traded because they are in demat post 2018 regulation change. And there are listed companies which are hardly 5 to 7,000. Now the base of the listed is increasing over a period of time because part of the unlisted actually is moving to this, and there is a lot of startup actually which is again moving into public limited, and then eventually they have to become kind of a listed company when the market actually helps them raise capital. So what is the I would say the pros and cons? So in terms of pros and cons, first you have to understand what is happening in the market. So you are a small company, then you become a mature company, and then you become a listed company. When you are actually a, so there is a startup stage, growth stage, and then matured level stage where you say that, okay, I'm now ready for the public IPOs. So you have to catch the eyes. So first, basically, there are entrepreneurs who are absolutely prepared from their Series A that they have to go to public. The reason is many companies are even D2C. So if I talk about pros, so you have to catch, those companies. So first of all, it's definitely a risky investment, I would say, but because of the liquidity not being attached, but there is definitely a value creation which happens. All depends upon what stage you have invested actually, because this entire, like starting from Series A going up to IPO, there could be 50 to 100 times returns actually. Now you have to see where exactly which point in time you invest. So you might have seen actually a lot of people invested at an early stage and then they become actually kind of a millionaire the moment they took exit through IPO, and that has actually happened. Because you really catch the eye at a very, very early stage. So the moment you grow, you become more liquid, because a lot of people, you catch the eyes of a lot of people actually, both institution as well as so there in the good market there have been access to angel investors, like those who invested in Echo. There was a round actually, and a lot of ESOP holder even divested. Even in Swiggy, that same thing happened. There are buyback programs actually which keep on happening in every large startups, and there are exit which happens for angel investors to ESOP holder to many other guys. Now, thing is basically you have to pick and choose the right company first of all. So your investment has to be right, even if there is no liquidity currently, even if there is liquidity which is going to happen through liquidity event, which could be M&A or IPO. So you should be clear actually what you have picked. So I would say it is not. So tomorrow if some bad investment become bad investment, you don't have to blame the market. I would say there is always a market. For good stock, there is always a market. Now the choice is yours, whether you invest in a profitable company or you invest in a loss-making company. So first you have to correct the right basics. So before I comment on the pros and cons, I would say pros and cons are mostly known to each and everyone who invests in the unlisted market. There are always problem of picking the right one. Who's going to outperform, who's going to have a last mile runway, or you can say who's going to be actually outperformer vis-a-vis the other players. So if there are 4 players in the market, actually all are funded, but actually which is doing well. So in the food tech market like Swiggy and Zomato, both survived, rest all actually have gone for talks. So you know that which one to bet. So you bet on somebody, in the food tech, you will never have the success. The reason is they can't beat, companies like Swiggy and Zomato, and the market is actually happy with 2 players. They're not looking at third player. So there is definitely, certain basics which you have to follow, and then you can actually talk about pros and cons. Okay, now these pros and cons apply to me or not. So when you actually jump into the unlisted market, you first look at actually what are the risks. So the risk is definitely less liquidity, and there's a longer term horizon if you really want to be a multi-bagger, in terms of your wealth creation. So you have to identify the stock accordingly, and then you have to perform accordingly in terms of like patience, in terms of holding on to stock. You don't even take leverage actually. All that stuff basically is the hygiene factor. So same thing can happen for listed, because what happens in listed versus unlisted, if you borrow tomorrow, like on a listed stock, you can still repay your loan because there is some value which is left even if stock falls. Here there is no no value actually. At time it becomes zero, at time there is no taker actually. So where do I sell? So that's always the risk, but this risk should be factored in when you invest actually in a stock. And the good part is basically the value creation, what happens actually over a longer period of time is much better than the listed stock. The reason is basically you always the listed investor look at the kind of returns which is in the range of say 20 to 30%. That's what basically the market has delivered on a on an average basis for all PMS, AIF or whatever actually who have been there as investor. In unlisted market, in the private market, the return has been actually phenomenal. So all depends which stage you invest. So early stage fund in India actually have delivered 25-30 or 30 to 40 even. So the the better, I would say, there are deep tech fund who are delivering 30-40 plus. Then there are consumer tech and multiple others who are delivering say 25 to 30, and then there are pre-IPO funds who are even still delivering better than what listed stock performs. So that's what basically has happened actually over a period of time in terms of return generation. And so all depends actually in terms of asset allocation also, because you can't actually skip. Earlier there was no opportunity available. Today you have opportunity available. So a lot of family offices even have diversified to unlisted market through their alternative investment route. So instead of taking the exposure to AIF, they are now taking the direct exposures.
So, like you mentioned, because you have to look at the company that you're investing in, the profitability and all of that. So what factors as a retail investor should I look in while investing in any unlisted shares, companies right now? What factors do I have to really look at? Can you, name few of them?
Yeah, so basically I would say, see, there are multiple factors which you obviously have to consider while choosing a company. First of all is the sector basically. So as an investor, maybe certain thing you understand, certain thing you don't understand. If you understand a space like fintech, say for example, or maybe you understand consumer tech better, I would say rather go with those actually which you have a bit of understanding. So at least your knowledge gap should not be there actually, that you don't understand the space and you are writing the checks accordingly. So my advice to, when you are actually getting into the unlisted space, suppose you are a techie, you understand tech very well. So at least you can evaluate this product is really doing well. Maybe you can check, from formal, informal sources, how this is the performance. Because in an enterprise solution, you are pretty sure, like in a SaaS product, that the moment actually company is done with their product and they have launched into the market, after that this is a all profitable journey. You can't actually have a one story from a product company which has already a product launch in the market and the customer already on onboarded. So after 2-3 years you will see all profit actually, because margins are pretty high actually in those businesses, even in the services business. So where you are actually providing SaaS services, so there can't be a bun story. So if there's a bun story, obviously there is a red flag. So I'm saying these are the things actually which you need to first look at, and then you need to look at actually the financials, because to the extent there are always financials available in the public domain, there are relevant news also available to the company. Obviously you should also find out any kind of integrity of the promoter related stuff actually on the Google, or maybe any kind of a public domain. So there are certain hygiene factor which again you always look at when you are investing in a listed or unlisted. Those hygiene factor remain as it is, I would say. So if you have a certain limitations, if those limitations you feel that are critical to evaluation of investment, then obviously you should not invest till the time those limitations get over. Say for example, you don't have ready financials, or you don't have certain KPIs available. So if you are not writing a large check, what happens is at time you might have a data limitation. But if you are still gung-ho about the sector and you still feel the valuations are right valuation, because there's a growth story which is much left actually in on the greener side, so you can always look at investing at early stage in those cases. So obviously there could be a at time hero or zero game, but those companies which are actually having good product, I don't see any kind of a hero or zero game. They will always be performing. They could outperform actually depending upon how the market actually takes their product. So while evaluating those kind of opportunity, you have to be a bit cautious about where exactly you are writing checks, and you should allocate the amount accordingly. So if you are actually investing, say more like an angel, obviously 2 to 5 lakh is the right band, or maybe 10 lakh is the right band. Putting all the eggs in the one basket actually definitely doesn't work. So you have to look at actually the potential of the company, and then obviously your asset allocation. So out of your actually allocation of say maybe 10 crore, you are allocating say 10-20% out to unlisted market. So within unlisted, again you should look at some early stage, some pre-IPO, so that you have liquidity also being available to you as and when required actually, because pre-IPO stocks are mostly the active stocks for good companies. Like it could be Boat, it could be Oyo at time, it could be Swiggy, it could be XYZ. So where there's a liquidity available to you. But in some cases where there is a early stage, we have found actually there is definitely less takers actually. Even if you offer a good valuation, then obviously you get stuck. So from an early stage, you need to have a larger horizon in place for investment. Then only it turns out to be a kind of a profitable exit for you. And from a pre-IPO, definitely horizon could be 1 to 2 years or slightly more or less. But mostly actually people look at those opportunity where there is a within 24 months there is liquidity event happening. So your investment horizon in place, keep a window actually which is very clear that okay, if I'm investing in pre-IPO, I need to look at it within this time frame. If I'm investing in say early stage, 5 years is my maximum, I should get a exit. Whatever actually happens, but I need to have some liquidity event out.
And let's say a very basic question: if any retail investor wants to start their journey with unlisted assets and investing in unlisted shares, what is the minimum investment I should be able to start with?
So for retail investors, basically through our platform, we have a USP also that you can write a check of 100 rupees, and we are providing even escrow back transaction, even for 100 rupees or a 50 rupees transaction. So as such, there is no limitation of ticket size we have kept. The way you buy listed, even a single share, you can buy a unlisted actually single share on the platform. The objective, but obviously you don't make return on 100 rupees. You make return when you invest sizable. So 1 lakh or 2 lakh, but ideally you should do a SIP. So even if say there is a time gap for exit, so if you're investing in a pre-IPO, you should actually keep it like 5 installment or maybe 4-5 installment, so that because the price may keep on moving up and down. So if you feel that there is a volatile market and there is definitely a price movement which would happen, then you should plan it in a 4 or 5 installments, that okay, out of 100 rupees, 20 rupees every month you will invest for next 6 months, because after 12 months there is something which is liquidity event, IPO can happen, and you will see the action happening across. Because before the IPO, if the market is volatile, then obviously the price movement you will see actually, you know, up and down, up and down, up and down. So every month you can invest 20 rupees and then eventually average out. So you can start with a smaller amount. My piece of advice is start with a smaller amount, say maybe 1 lakh, 2 lakh, then gradually grow it. Take your experiences first, and then eventually, you know, try and do a double betting actually on those stocks which outperforms.
Okay, hope that answers to a lot of retail investors and hope that helps. Very understood. Okay, coming to you took a few names of the companies, right, where people have gained
Yes.
from unlisted shares as well. So name a few, name some of the companies that you have on your platform, and which of them are really famous and in demand among the investors today.
So I wouldn't say that because the platform became live hardly a year back. So it's not even a year actually when we became, but we have been dealing actually in the market offline mode for quite a long now. So I can talk about say studs. I'm giving you some examples which have really given good returns to the investors. So it was like 40-50 rupees maybe in 2018, 2019 or that era. And in last 6 years, basically the peak actually it has touches roughly around 1600, 1700 odd. And even currently it is somewhere around 900,000 odd or maybe 800 odd. So I can say that even as of today it's more than 20 times in last 6 years or 7 years, whatever you count. So CAGR wise, definitely it has grown. People know the name of the stud being a helmet company and 75% market share. So there are companies actually which are performing good. See, there has been might be fluctuation in the price because the earning have dropped. Why the earning has dropped actually? Because the commodity prices have fluctuated. So now this year they will see the maybe good numbers actually coming out, and again the price will be back in action. Sterlite Power actually. So this again was in 3 years last, if I talk about even not even 3, 2.5. So the stock actually has post even you can say bonus. So there has been quite a 5 timers kind of a return actually, because it was hovering around say 200 250 odd. Moved to pre bonus, it moved to somewhere around 1700 odd. So and even as of today it is somewhere around 1100 odd. So in a way basically it has still be more than 4 times 5 times kind of story, and there is a lot of steam still left. So there are stocks which have given in last 3 years 4 times 5 times returns. Then there are stocks basically which have, like if I talk about say Care even, which was hovering around again 40-50 level, it touched 240 to 50 level, that too in 3-year period, and again it is say 175 odd. So if you count from again 40-50, again it is 3 to 4 times minimum in last 3 years itself. So a lot of movement actually has already happened. Maybe once the IPO market again get rewind. So basically what happens, how the price movement happened in the unlisted spaces, basically demand and supply. So if you are an institution guy, if you are buying at a right price, the way institution buy, you should also have the same thought process while buying. Your entry price and your exit price both are important to give you returns. The same thing institution does. When there is a fear in the mind of the people, he buys. The same thing retail should do. So you should not actually be wary of that company is going to die. Company will not die because of the bad results. Maybe because the market was not bad for a particular year. That's the reason stock has gone down. And again, this will outperform, because when the market revives, it definitely has to bounce back. So, and the most of the movement actually starts happening in the unlisted market for unlisted stocks by 2 factors. One, related to results announcement, and any corporate action. These are 2 major drivers where basically the price keep on going up or down. So you have to be very particular. If you are bullish on a particular counter, just buy before the results. If you are bearish, sell before the result. If you are actually bullish and there is something which is going to happen on this counter as a corporate action, definitely maybe some M&A would happen, something would happen, or they will acquire someone. I'm not saying it's insider information. There could be insider, but I'm saying there could be visualization even, that this is a company which is becoming target for lot many companies because other peer have been acquired. So the valuation actually goes up, because there is a peer peer getting acquired at a higher multiple. So this unlisted company is definitely doing good, but there's no one acquiring it. So valuation also goes up in a way. So the market actually factors. So in a way, I'll tell you one more thing, which is basically very relevant, and most of the people miss it is try and find actually comparable of unlisted company as a peer set in the listed one, and then look at actually how much they are discounted. So if they are really discounted to their peers, say for example a hotel company, I can just talk about Sesame Hotel, and it's an unlisted company going for IPO. And now, if it is, nobody knows the valuation as of today, but I'm saying if it is really available post listing at a price which is comparable with its peer, or in the unlisted market at a price which is lower than its peers, better to bet for those companies. So look at even technology company. If there is a better technology in the unlisted space and there are poor technology company commanding a high premium PE, so look at a company which are doing better actually in the unlisted space. They can actually create better value the moment they go public, because there's something is going to happen actually more like a corporate action, more like a corporate event or a IPO event or liquidity event, which will actually add value to it.
That's actually a great insight, and I'm sure that will really help. That's actually really a great insight. Great. So tell us, what is like the ideal holding period for unlisted shares?
See, again, you have to create baskets. As I told you that there are two baskets. One pre-IPO, another is early stage. So unlisted market is very big. I mean to say, you have early stage startup companies, you have a mix of public limited companies. Some are going for IPO, some are not going for IPO. But at times you realize that, you eventually you have to be opportunistic. So if there is an opportunity to bet on certain company, which are definitely going to be say 10 timer, 20 timers, I would suggest you have to be patient investors. You just, wait and watch. That 10-20 timers could be in 3 years or could be in 5 years, but just wait and watch. So for pre-IPO company where basically you just invested in a horizon of say 1 to 2 years, you actually are waiting for some liquidity event to happen, and you are sure of that their peer are listed at a higher multiple, you are getting something at a lower multiple, you just get into that and look at actually your returns. So as a retail investor, I would say that look at returns actually in the range of say anything above 30% is definitely good. Anything above 30%, because what you're getting as a investor in the listed stock, if your return is say 10 to 15% delta, okay, on a CAGR basis, so that's the right kind of a benchmark for you to actually invest in unlisted. So I would say if your stock actually gives you 20% in the same sector or subsector, say hotel industry, and you are actually able to get say 20% CAGR, if my stocks actually gives you, unless in the unlisted space, 30% is kind of a CAGR, I think it's a good opportunity for you to actually encash on. Okay. And how you do the calculation is basically the expected multiple at which they will end up actually when they come up with the IPO. So even if the horizon is say and obviously another good factor actually what works really really well for unlisted company, at times they are growing much faster than the listed companies. So the multiple or a PEG which is meant for growth, so basically that factor actually if you look at could be on a higher side for unlisted company versus listed company. That's what basically had been working in the past for many multi-baggers in the unlisted space.
Got it. Okay. Also, Manish, could you elaborate on the due diligence process that you guys follow to ensure the authenticity as well as the quality of the shares that you listed on your platform? That you have on your platform. I wouldn't say listed.
Yeah, correct. See, basically, first of all, as I briefed you that we do not actually want to recommend anything. We don't work on a buy side or a sell side. Mm-hmm. What we look at is the quality of the company, quality of the management. So we have our own process actually to do some kind of a diligence. But obviously, there are two ways to look at. One, there are companies which are actively traded. So there is some demand already coming in. So I'm just going to go with say some of those active stock. It could be 40-50 or it could be more than that. So which the market actually keep on trading. So that's one basket. Second is basically if somebody actually wants to say institution comes in or maybe any investor comes in, or could be retail, could be anybody, if he comes on board actually with us and says that okay, I want to really take your expert advisory and let us know actually what you are good at in terms of your portfolio, in terms of the portfolio you look at actually while, or you suggest to someone. So we basically are driven by certain factors. So what we do is basically more like an internal process, that we first meet the management, go to their plant in case it's a manufacturing, or try and do some validation actually from their vendors. Just look at actually what are the potential of this industry, both India and global. What are the peer set in listed? How much are they relatively valued in the unlisted market versus their peers in the listed? And then we'll look at actually any governance issues, promoter issues, or XYZ issues, which could be, more like from a hygiene perspective. Are they over leverage? What are they looking at from IPO? And when exactly the exit is going to happen? Is it through IPO or some other M&A? And at what valuations? Are they realistic actually on their asking actually when they go for valuations? And is it something like, will they be able to achieve, or what exactly are they going to do, primary or secondary in the IPO? If there is all secondary, maybe we can doubt actually the IPO will become successful or not. So we look at some possibility actually of becoming their successful story down the line once they chase the IPO. So eventually we look at all the factors and then look at actually what is going to work, what is not going to work. So in a way, basically, we always look at things, which a rational investor would do, so acting on their behalf, basically we keep on doing all this, so that because we want to be mentally prepared in case someone asks us question that, okay, you tell us why should we invest. So we are ready with those answers. We keep our data set ready. Most of the cases actually we get access to the management, and that's the reason basically, when we say that, okay, we are highly convinced, it is basically basis our process only rather than anything
and
else.
You have a dedicated team for that who does all of that.
So yes, so there is a team, and then obviously we look at our own, because it's not that we leave it to team only. We obviously consult many advisors. So say for example, if there is a deep tech company, I will just go to someone actually who invest in that space, and then I look at some other investors also who might be already invested in that space and they know the ecosystem. So we will do a ref check or a promoter check, some kind of stuff actually we also do externally and internally, both ways.
Understood. And how do you envision the growth of unlisted assets market in the country, in India, and what role do you think you're going to play in the next 5, 10, 15, 20 years?
So basically, if I just talk about unlisted, so the ecosystem is still evolving. We have seen the liquidity which was there actually, hardly 1.5 years back. So we know that people are now at least accustomed to hear what unlisted market is all about. Earlier, if you talk about say pre-IPO, nobody was aware of pre-IPO. If you talk about say buying unlisted shares, people were not aware of unlisted shares. So basically, at least it sounds as a music to our ears that somebody knows basically the market already. So if you pitch to someone, they know it actually. So if you pitch to say family office, if you pitch to any institution, if you pitch to any retail, at least many people are still know, okay, see, they might be stuck with their investment. That's one area. Maybe it could be a bad investment, it could be XYZ good investment. If they really have a good investment, then definitely they are coming back to the market and then actually helping us a lot. That's what basically I would help in. So we always look at people who really understand the ecosystem, and we really want the support of those people actually to support the entire ecosystem so that it get evolved with the right metrics, right thesis, and obviously with right values. So we don't want actually ideally an ecosystem which get evolved with the bad or unethical practices, those kind of stuff actually in a way. So we really look forward that there are people joining hands, there are institutions joining hands, and then helping us to grow the entire ecosystem, because you cannot avoid this, because startup ecosystems, I'll tell you basically why this ecosystem is important for secondary. See, if you are actually, be it a government or any regulatory body or anybody, if you are not helping the secondary ecosystem to evolve and develop further, that means you are actually in a way, aap mera gala hi daba rahe ho actually in a way. So you're taking away my oxygen. The reason is there is a circulation of capital. So I'm investing. Okay, where do I divest? That is one part. If I don't divest, there is no churn of capital. If I don't divest, there is no, recycling of capital. Be it foreign capital, Indian capital, doesn't matter. But there has to be churn of capital to come back to the, same, maybe not same players, other player of the ecosystem. right? To help them grow. So if my money is stuck in, say, Swiggy, I can't now fund any other company in the ecosystem or maybe some other ecosystem guy. So what is important actually is to understand from an investor perspective that, if there is no churn of capital, he wouldn't be able to redeploy the capital. And faster the churn, that means he makes more return for the investors, for his own, LPs or the investor set. So in a way, the churn of the capital is important. When there was a lot of liquidity actually available in the ecosystem, there was a lot of, investment happening across. And it is, I'll tell you one more thing is, which is very, very important. So suppose if I don't get a churn of capital, what's going to happen is, if there is a, good idea, good concept, good startup actually, which is really growing, but they need fuel to grow. Like we have also seen some early stage startup, actually they die. The good startup dies. The reason is basically no capital available. So if I talk 10 years back, that definitely there was no ecosystem. Today, we definitely have ecosystem. Now, why the reason secondaries are important is, secondary help you to churn your capital. So what would you do? If I give you, say, you invested 1 rupees, I give you 2 rupees or 3 rupees actually in your pocket, you are at least going to reinvest minimum 1 rupee, because that was the capital return, right? The profit maybe you may be keeping actually with you, or maybe you redeploy profit and you take back the capital, into FD and all. So what I'm saying is, the alternate market actually grows with the higher churn of capital actually, and secondary is definitely is the one which really helps you to understand and get you the churn of capital faster. So if there is no ecosystem of secondary, then definitely we are trying to put off the oxygen from the entire ecosystem, because that's the kind of oxygen for those startups which are now flourishing. So if you don't take out the capital from bad assets, so say for example, I'm just telling you, you invested like a bank, bank asset get NPA. What do? You finally sell the asset and realize your money. Here the investment could be good investment, bad investment. Now the good investment is which gives you multiplier. The bad investment is which at least give you cost. I'm not saying that at least it make your capital dead. So it gives you one timer. So you say, okay, no worry, I invested 250 crores. If I get 250, I'm fine with it. So even if there is a ecosystem to support that 250 crore back as capital in your pocket, definitely you realize that, okay, yes, there is something basically now back to my pocket. I can redeploy because I made some mistake. Now I have got the right opportunity. I am looking at those. So you don't invest, say, in one asset. You now deploy in 5 assets. Maybe you change your strategy, you do mix of things, and then eventually you turn out the things better. So what happens is basically, at the end of the day, the churn of capital would not happen if we don't create a liquidity ecosystem. The government has to realize that there has to be, when there are developed markets which have already come up with the regulation, there are systems which are perfectly working over there. So there is a well-defined regulation, well-defined. So even if the broker actually in the US market has a broker-dealer license, why can't we have a broker-dealer license? Because every banker actually becomes a investment banker and then become a spoiler for the market. We really want person should be the one actually who really had an acumen. He should be the, like SEBI says that you have to be RA, registered advisors, investment advisors. So you have to be, you have to pass an exam, you have to do certain things. But how about unlisted market? So unlisted market is not actually governed by any kind of a regulation as of today, but the regulation really is going to make it multifold growth. So that's the only gap we see. While the growth kind of a growth hampener for us, because there could be less of a trust factor, less of a liquidity till the time all the institutions jump into this market. Maybe today there are only 5%, 10% institution jumping into, but there will be larger play when many institutions jump into the market of secondaries, not primary. So currently there are players who are actually doing primary, investing from AIF, investing as a VCP or as a family office. When it comes to secondary, they don't look at secondaries. So they look at secondary only with limitations or with constraints. So they say, okay, if you give me at this, but let me tell you one more very, very important thing. As an institution, as a retail investor, you don't get a price discovery through primary. So your existing set of investor will never allow you to do a down round, right? In many of the startup, you will never see a down round happening. You always see price graph going up. But when the market is going down, you never see that happening. The price graph going down. That happens only through secondary. That's the reason basically whenever there is a publication in the media that Baiju prices come down, Swiggy prices come down, or maybe XYZ Oyo prices come down. Now they have started a pricing as well. So who does that? It is all through basically gray market transaction or secondary market transaction. It happens. So eventually there is a price discovery which will become a proper price discovery if there is an ecosystem evolved, and there are platforms which basically like us who are really trying to bridge the gap. So trying to bring more and more into the ecosystem of secondaries and do a better job, at least for the investors to make an informed decision. So we see this market actually growing multifold. I'll tell you basically one more thing. In the IPO market, you would not have seen so many SMEs IPOs. So SME IPOs have actually outspaced the number of companies which are hitting the main board. So there were, say, 70-80 companies hitting the main board last year, and there were 170-180 companies, more than the numbers actually which was there actually for main board company. And the capital is also huge. You are going for raising for maybe say 50 crores, you get a 5,000 crore subscription. Why? The reason is basically a lot of people actually who were not actually participating in the entire story of capital market in the small company, because exit happens at a very, very slow pace. In the small listed company, you see mostly are illiquid stocks. But when it comes to the good companies who are really, really growing company, so those small company of 200 crore market cap, say, is definitely having potential to become 2,000 crore. Now at 2,000, they would not be actually liquid. They definitely would be liquid. And the exchange also are supporting that there is a market making concept at least for 2 to 3 years. So there you get protected. So at the end of the day, what you have is basically in place something basically which is going to protect the investors and create value also for the investors. So now a lot of businesses basically doesn't want to reach out to VCP. Maybe they say that, okay, we are constrained by their set of limitations. We really want to hit the IPO because we are profitable. So if there is a company which is profitable, there are avenues actually to go to VCP, and then there are avenues actually or options to go to even hit the capital market and get a right valuation. If they get the right valuation, they are there. So I'm saying that eventually it is your choice, but it is helping a lot to the investor fraternity to actually get an exit through, because you already know. So Lata being a small retail investor, she knows that IPO is going to hit the market actually in 6 to 12 months. So be it for a larger company or a smaller company, if you really are meeting all the criteria which you define for larger company, for the smaller company as well, it doesn't hesitate you to actually put your money out there. So it is all about returns.
And
so we see actually a lot of companies which are SME. Now, if you look at our GDP, 45% of our GDP actually comes from SME company, MSME and SME company. Yeah. But if you look at how many of it is actually funded by equity, it's not even 0.1%. So how much capital market contribute to them is almost negligible. So many are promoter funded company or bank funded company. They are not equity funded company at the end of the day. So be it in manufacturing, be it in service sector, be it in IT sector, all IT company you will say promoter driven companies. They are not even VCP, because they are service company, and VC says, no, I want growth of every year 100% growth. Services cannot have 100% growth. They are still growing at 40, 50, 30 every year. So the growth is growth, and they are running profitably. So they don't need even capital at the end of the day. Yeah. They now take a part exit, or they get the capital for growth through this mode of SME listing. So in a way, basically what happens is at the end of the day, they are able to get what they need without diluting too much. So they looked at actually the growth capital. Now avenues have increased for them. So that is helping the ecosystem to grow further, because those SME are now open to your investment, to retail investment or institutional investment. And we have seen actually right now the euphoria is so strong that there is a demand coming in, there is no supply. The demand is more than actually outpacing the supply side. So you can make out now what is happening actually.
And this is just beginning. This is
just beginning because we have more than say 12 lakh companies. I am saying 70-80 thousands are public limited companies. This public limited status will definitely go as going forward. This number will increase to maybe few lakhs here and there, because you just have to convert from private limited to public company, and even you have to be profitable. So you are meeting the exchange criteria. So at the end of the day, companies which are having 5 crore PAT, maybe 3 crore PAT or 10 crore PAT, they are still able to get some investors on board with them, be it even retail, to actually fuel their growth for expansion side.
And just a follow-up question to that. Other than deep tech and consumer tech, what are the and of course there are SMEs also. So what are other industries which are very much in demand and which are good to invest for the next 5, 8 years or so on?
So see, basically, how the market works is basically, I would say you can easily look at say 1 to 2 year very clearly. I don't know about 5 year, 10 year. So if I talk about say 1 to 2 year, the trends are pretty clear. As of today, sitting, if I talk about say companies or sectors which are definitely going to outperform, defense is one, because India defense stories has just started, be it tech or non-tech. And if I talk about say fintech, the story is humongous. Like the kind of growth actually which we're going to get, only gap actually is how quickly the government adapt to regulations, how quickly the government adapt to the global evolution of technology. So how they adopt to Web3, how they adopt to XYZ, I wouldn't comment, but I'm saying how they adopt to the global scenarios. That's the way basically, because the entire global banking market is going to get changed and will actually move on to blockchain. So adoption of blockchain as a technology actually is going to definitely change that entire game of banking in India and globally as well. So this again works very well. Then you have a deep tech again is very, very divided actually. So it could have a space tech, it could have a clean energy. So clean energy as a theme is really working. So because there is a post war of Ukraine and Russia, there is definitely a concern of lot many countries, be it developed or developing, that there is a net zero concept which they really want to push it. So even if you are taken a target of as a country of 2070, India wants that 2050 we should achieve, or even 2040 we should achieve. So net zero is something basically government is trying to push. Even Nitin Gadkari yesterday made a statement that we really want a ethanol driven vehicles even in the country. So blending will continue, but we will want hydrogen driven XYZ. So basically there is a lot of push actually which is going to happen. So we will see the phase out of even EV, the growth of the EVs actually very massively, even hydrogen based vehicles or adoption of new technologies so far clean energy is concerned, at a very, very massive pace than any other country in the world. So these sectors definitely the beneficiary, like even the automotive is going to be like auto ancillary companies are going to be beneficiary of this. Whosoever actually is taking EV as the kind of a threshold for their growth or benchmark for their growth, because they must have taken some technologies out there. And then there are some other sectors, like I can just say where you see so within consumer tech, like I wouldn't say every company has to grow, but there are certain defined sector, like because there are health and hygiene. So within health and hygiene, if you are doing something, so within health tech, I would say, because post COVID people have started focusing on health, so they are now not just only adopting to gym, they are actually looking at even be it yoga or be it XYZ, but there are people actually who are really shifting towards a healthy environment or a high healthy work life balance. So those things will actually move. So I would rather look at theme based should work in a better way. The underlying remains the same. Either you are disrupting or you are profitable. So these things should work, because there is no multiple of sales which I can pursue. I even don't see as a right multiple for any company. Even if you are a growth company, I still look at bottom lines. So basically the underlying for investment remain the same, even if you are a Indian company or a global company. And the sectors basically, obviously you have to choose which one is going to work, which is not going to work, and obviously you have to allocate your portfolio in such a fashion that you are not going above 10% in any of the companies or any sector as such.
Okay. Understood. And as a leading player in the unlisted assets market right now, Manish, do you have any appeal for the government or for the retail investors or for the institutional investors that you have to make?
Yeah, so basically, I would say there is definitely expectation we have from government. Fastly the government adopt to the tech side. Like I'll tell you, although government has been doing a lot of stuff, but it is still not catching the eyes of the industry. I'll tell you how. Our data privacy laws are still, the old one. The draft regulation actually came in after 22 years or maybe 20 years. So the IT Act was 2000. Now we have got, IT Act draft regulation, which is 2023. So there is definitely a gap of more than 20 years. So we are catching the eyes very late, and the law becomes so obsolete that nobody actually wants to look at. So there is already a violation which is going on, I'm saying. So for data privacy is there, or maybe any regulation is there. So for privacy of information is there. So these things actually are very crucial when you are building a large base. Similarly, cyber security attacks. So basically, we are moving towards high tech kind of a attack against the our entire ecosystem of be it defense, non-defense, or IT. So government has to basically adopt to the tools basically, so where basically they can protect the data, personal data, as well as the public data, so that we are all secured at the end of the day. So that data privacy and data security both are two things which basically we always want the government to act very swiftly. And second is basically they should evolve to the tech ecosystem and come out with the regulation for the unrestricted space, because this market can be very very huge and government could be beneficiary of this. Because what would happen is there will be faster churn of capital, investor will again come to the India market, because if they get stuck for longer period, they would never look at India market actually from an investment perspective. They will look at actually listed space only. They will ignore kind of from a unlisted space, because what happens is actually if you are investor, so you invest only in NSE or maybe XYZ names, you say that these are highly liquid or active stocks in the market, so I want to invest actually. This is what exactly is the thesis. But with the regulation coming in, I'm telling you, a lot of investors actually will jump into this market, and there will be more volumes, more traction, more kind of scripts available, and a lot of people will stay more private rather than hitting the public market. So public market actually, could be bad, could be good, all depends. So today, if you remain private and whenever the market is good, you become a public. So timing is more important. So eventually, you will be having a better ecosystem to churn the capital, to bring efficiency in the capital, to eventually help the investors to have their right protected, to have the investors not getting fooled. The retail investor also will look forward to the platform which are actually more like safe, secure, transparent, plus they are more like complied with the government regulation. So they will look at all the things which are right in the right metrics. The way they invest in listed, they should have the freedom to invest in the unlisted space. That's what exactly the market looks like when it comes to the reserve market. So we should have the same kind of a opportunity for our investor base to actually invest in the entire ecosystem, rather than just waiting and watch. So if company really going for IPO, then only invest. Why shouldn't I invest actually before? So if you allow the stock to get traded in an alternate mode, there is definitely a lot of people will jump into immediately, and there will be larger ecosystem of liquidity. That's basically the piece of advice to the government. And I would say from a retail investor perspective, retail can definitely make money. Only thing is the fear factor should be completely moved out from their mindset. They should invest when the market is really touching lows, and they should take exit when market is really touching highs, because they should know certain fundamentals, and they should look at first their own education, what the company is doing, what motors are doing, products are there, like what differentiation are they making actually when it comes to the market. All that has to be there on the table before they take any decision, and eventually invest in a, like as I told you, that they should start with a small check and then gradually grow, because it will take to have their own sweet learning and then eventually grow and then become a kind of SIP holders.
Okay. And anything to any appeal to institutional investors also?
See, institution, my piece of advice would be that as of today, price discovery is not happening. So even if they try and hunt, and we have seen actually happening this, we have spoken to many institutions, we are helping them also. Price discovery wouldn't happen actually unless and until they really adopt technology. So my request to them would be, or piece of advice would be, that in case they can actually come onto the platform and then really join hands and then look at price discovery on the platform, because in offline mode actually we really can't help to do a better price discovery. It is only through online mode we can actually help better price discovery. The moment they become more active, there will be more people actually joining hand, and they'll also create a larger liquidity pool. And this way basically they would have been, they would definitely get a better exit or a better entry price point. and obviously they have the tools also to negotiate, get into escrow, get into. So I would say that many investors are actually, or institutions are investing in the technology, but they are not making use of technology. So they should ideally use technology as well while making investments.
Okay, that's it. I think for every one of us. Okay, we'll wrap up this interview quickly, but before that, I want to ask you very quickly. This is a fan of cricket speaking. So, tell us about this stock CSK on your platform, and who owns it, and how is it doing, and if we can directly go and invest in, and yeah, tell us about it a bit.
So CSK is really very good stock actually. I would say from a unlisted, it's one of the gem actually of the unlisted market. The good part is basically there is a lot of institutions actually which are sitting on the cap table. Be it even LIC, I think Abu Dhabi Investment Authority also is there. Many institutions are there actually. Many family offices also have bought. So there are good names on the cap table. The unfortunate part is the liquidity. So if you want to buy 1 lakh, 2 lakh, you are rarely get a supply actually. So maybe there is a demand and supply mismatch somehow. And so it is basically driven by retail demand, retail supply. Retail push the demand, the price goes up, and the retail pull it down, then obviously price goes down. But I would say that CSK definitely has a future. Only limitation is because the management actually is not able to come out actually how they're going to provide liquidity to the stakeholders, be it through IPO or be it through this. But otherwise, if you talk about valuation, it is definitely undervalued, because if I talk about the brand of IPL, it is somewhere around 10 to 12 billion. If I allocate the 1 billion to each of the basket actually, and CSK is topmost, so it should deserve more than $1 billion, but it is currently valued at $500 million. So and this is, I'm talking about business valuation versus brand valuation. So obviously business value has to more than brand value. So eventually and the company is also profitable. So if I go by the profit metrics, definitely I may not be in a position to justify it, but the kind of visibility you would have actually down the line, because they have fan following, the largest fan following they have, I think more than 50 million fan following they have, and it's just growing actually, gradually it is growing year by year, and they really can encash and monetize even in the Web3 world. So they can actually create a lot of value for their own stakeholders. That's what I believe.
They have the community, and the question is they have different sources to, of course, validate that.
Yes.
Understood. Got it. Thank you so much, Manish, for joining on this conversation. Very insightful. We really got great insights, and I'm sure every one of us has got that. Thank you again so much. And guys, please watch this very interesting conversation, and we'll bring you more conversations like these coming back. Thank you so much. Have a great day. Thank you, Manish. Bye-bye.
Thank you, Lata. Thanks for your time. Bye.